We're going to start writing out the answer for BASSET here. I'm going to use these subheadings. So we've got briefing notes here, the major title, and I want to show you how you get the professional marks. So I've put down my own interpretation of what the professional marks are based on the examiner's report. Okay, so the title of the document, I'm thinking maybe half mark, and then I have got this thing called to from CSYD. What does CSYD stand for? CSYD is this. It's that I've colored in yellow. All right. Client, subject, year end, and the date. But please take note that from now on, the date of the exam is going to be 1 July 20X5. So your year end is going to be somewhere in 20X5. And 1 mark is for the headings within the document so that you can have a structured approach, the main headings and the subheadings as well. And the clarity of comments here would depend on the quality of your explanation and whether you have actually answered the requirement of the question. So under normal circumstances, it would be very easy for you to get at least 3 out of the 4 marks here without even breaking a sweat. So we've got the main heading, briefing notes. If you're doing this in the exam, I would suggest that you have it in bigger fonts or in bigger handwriting. Okay, then you've got the introduction here. I've not done the introduction in an essay format. I find it so much easier to actually mark the paper when my students use bullets. But the bullets does not mean 1 mark answers. I've made sure that I have used the verbs inside the requirement of the question so that the examiner can see exactly what I'm doing. I find that when students do it in an essay format, all those 4 points in the requirement of the question are all sort of mashed up together, and there's a tendency for them to sort of just put down 2, and then the other 2 they tend to forget. So I've told my students to do it in the form of bullets here, but making sure that they put down a proper introduction. Okay, and I think that's fine. So then we're starting with the audit risk. So what would be the first point? The first point that I'm going to put down here is I'm going to start off with the easy points here. The easy points here are my point number 2 and number 3. The point about the new client here is 1 mark. So we've got BASSET is a new audit client, and then we've got the risk here is that the audit team may not be familiar with the accounting policies, transactions, and balances of the company as we do not have any prior experience with them. Consequently, the audit team may not be able to detect the financial statements that might be materially misstated. That's only 1 mark here, okay? Then we're moving on down to the opening balances. It's also to do with the new client here. There's an initial engagement risk here is that opening balances may be misstated. Consequently, closing balances may also be misstated. Now we're going on to the third point. What's the third point? The point about the impairment. So I start off by putting down the facts in the question, and the facts are that the overall revenue has fallen by 3.2%. But the question also tells you that the revenue pertaining to hard copy publications may actually have reduced by a greater percentage, only that it may be masked by an increase in the sales of digital publications, and management is not planning to test the CGUs for impairment. So that is from the exam question, which I'm just going to call it my observation. Then I'm going to go on to the accounting treatment here. You don't have to put down this part here. There are no extra marks given here. So if you want to leave it out, you actually can. CGUs must be tested for impairment at the year end. Once the accounting treatment part is to do with rules in an accounting standard, I prefer to use the words must, should, to make it very clear as to what we are saying. So the CGUs must be tested for impairment at year end if they're indicators of impairment, and a fall in revenue is an indicator of impairment. Then what is the rule? How do you go about calculating it? Then the carrying amount must be written down to its recoverable amount, and the impairment loss must be taken to the SOPL. The risk here is that the necessary impairment has not been recognized. Remember, the finance director actually said that they're not going to recognize it. Consequently, PPE and profits may be overstated. So when you're coming down to the consequently part here, try and think a double entry. Okay, so if you're dealing with impairment loss, the double entry here would be one part of the entry would go into the P&L and the other part of the entry will affect the PPE itself. All right, think double entry. Now, I've put down all these points here, but how does it actually work? To write out the answer, I've actually got an exam technique, which I'm going to refer to as OMARI. So what does OMARI stand for? The first one is to do with my observation. There are no marks given here by the examiner, so I'm going to try and keep it as short and as clear as possible. Then after that, we're going to go on to the materiality calculations. And as far as the marking scheme is concerned, we only have a maximum of 4 marks here. So if you have a look at my plan here, I have got 1 point that I've colored in green, 15.8. Then we've got 8.3%. That would be the second one. Then we've got the 17.9%. Do we have anything else? So we've got 15.8, 8.3, 3.6, and 17.9. So I've already got my 4 marks inside there. Then A stands for the accounting treatment, and we're going to talk about the rule here, the accounting rule. Then we're going to go on to the risk, and then we're going to look at the impact on the financial statement item. And based on the marking scheme here, the accounting rule here is 1 mark, and the risk here is 1 mark, and the impact on the financial statements here is 1 mark. So if you use OMARI, you will make sure that your answer is balanced, it's not lopsided, and you've covered all the elements that are inside the marking scheme itself. Okay, moving down, we've got Intangible Software. So again, I have made use of OMARI. We have got during the year 15 million invested in software, which is actually the O. Then we've got the materiality here. It represents 15.8%. And then there's this part here about the purchase software that they have recognized as an intangible. You're not going to get any marks for that. So if you don't want to put that in, that's fine as well. Then we're going to talk about the 10 million invested in the internally developed software. On the area of the accounting treatment, I've already done this for you. Here, save us a little bit of time. The accounting treatment, the risk, and the impact. And on the accounting treatment, try to use the words should not, must not. Okay. And on the area of the risk here, we're concerned that the research costs may actually have been capitalized in order to enhance the profit figure. Consequently, the intangibles, specifically, we're talking about the software here. So you need to be a little careful in the exam. Do not put general titles down here. Don't just put down the word intangibles. Be as specific as possible. Right? So the intangibles may be overstated and research expense understated. I mean, you can do it this way, or you can also say that instead of research expenses understated, you could also have said the profits overstated. If you did not want to do this, you could have done that, which is fine. Now, once you've looked at the software that you've capitalized, then you're going to think about the amortization, right? That was the next point that we had in our plan. So here, we're using OMARI again. So we've got the observation here, but we don't have the materiality because we already calculated it earlier, so we're not going to get double marks. And we've got the accounting treatment here, the accounting rule, how it should be amortized on a systematic basis over the life of the intangible from the date it is available for use. And here I'm saying in this case, the software has already been implemented and therefore it really should start amortizing it. Risk here is that the development cost of this particular software has not been amortized. Consequently, the development costs may actually be overstated. All right. And you can say profits overstated as well. Think double entry. So here we've got the risk and we've got the impact on the financial statements. This item in our answer plan was the point relating to the segments. So here again, I'm using OMARI as well. We don't have the materiality, so we're going to go straight to the accounting treatment, and then we've got the risk and we've got the impact. So the accounting treatment here is that the listed companies about the performance of their operating segments. Okay, and here the digital publications alone should be treated as a reportable segment because it takes up more than 10% of the group revenue. Risk here is that there's no disclosure in relation to digital sales because at the moment they are showing it under the category of the publications, the newspaper and the magazines and things like that. really should split it up into hard copy sales and digital sales as well. The item in my plan is the publication rights. So I put down the story that the publication rights range in a period of exclusivity from 5 to 30 years, but they amortize over an average of 25 years. Then I go on to the materiality, and you've got the accounting treatment that amortization should be over the specific useful life of the specific intangible. And then I go on to try and apply it to this particular scenario. So I'm saying here that in this case, each one of the 200 publication rights should be amortized on a systematic basis over each right's own period of exclusivity. They should not be amortized using an average of 25 years, and the amortization charge should then be taken to the SOPL. Risk here is that they continue using 25 years for those items that have got a life of less than 25 years. Consequently, intangible assets, specifically which one? Specifically, publication rights may actually be overstated and profits overstated as well. Then going on to the royalty advance, we've got Omari again. So the framework does not change. Omari actually helps you to put down the answer systematically and in a balanced form as well, making sure that every component of the marking scheme has been included inside your answer. Okay, so royalty advance, a story here. When the book is commissioned, the author is paid a royalty advance. Since there's a dollar value, we calculate materiality as well. Now, the important thing when you calculate materiality here is this part here. You need to make a judgment call to say whether it's material or not. If you don't put that down, you don't get any marks for it, even if your calculation is correct. Then you've got the accounting treatment. Treating the royalty advance as a prepayment is appropriate because the revenue has not yet come in. The royalty advance must be charged to the P&L once the book is published. But then the period that it is spread must be over that specific period of that specific book and not an arbitrary period of 10 years. Risk here is management continue to use the excuse of the industry practice and continue to amortize this over 10 years. Ultimately, current assets, they did say current assets, but current assets is a very, very general classification. So here we are specifically talking about the royalty advance may actually be overstated and the profits overstated if they continue to use that 10-year period. So what's the next item in our list? Looking at the foreign results of this foreign subsidiary, the accounting treatment here is that Borzoi's transactions for the year must be translated using the spot rate. In this case, a monthly average will not be appropriate because there has been significant fluctuations in rates in this country. So I'm trying to apply it to the scenario as much as possible. Risk here is that they end up using an average rate. Consequently, if they do that, then Borzoi's income and expenses may actually be misstated. Okay, now since we've got the results, let's move on to the assets and the liabilities. Now here, we don't have to put down the story again. Okay, the story here is Borzoi is located overseas. And since it's related, I'm not going to repeat the story. It's going to go straight to the materiality here. We've got assets and liabilities, and we have got the percentage here, and it is material. Then the accounting treatment, the assets and liabilities must be retranslated using the closing rate, and I have specified the closing rate as at what date, and that is the company's year end. So risk here is that they end up using a rate other than the 30th of April. Consequently, Borzoi's assets and liabilities may actually be misstated. Okay, now as a result of this part here about assets and liabilities being retranslated, we have got another point here, and that is the foreign exchange gains and losses arising from the retranslation of a foreign subsidiary's balances must be recognized in OCI. Risk here is that these Forex gains and losses have been taken to P&L just like normal translation, but that's not the case here. Okay, we've got the retranslation of a foreign subsidiary's assets and liabilities. They have to be translated using the closing rate, and the exchange gains and losses have to be taken to the OCI. The next item here is on the area of the translation software, but actually we've got more than enough points already. So we Just going to show you just very quickly how this works. We have got the story here, our observation, the materiality, the accounting treatment, the risk, and the impact. Okay, so it's really very simple, but I'm not going to spend too much time here. So on A, part 2 of the question, we've got the part about the professional skepticism. Again, I've already typed out the answer here for you, so you can save a little bit of time. All right, so the first part here is BASSET is listed, and the revenue has actually gone down, and therefore management may be under pressure. Okay, and this could lead to a range of inappropriate accounting treatments, and we're saying here that the audit team must be skeptical and watch out for creative accounting like some of the following areas. But I'm not going to put that many down because you've got to remember that in the exam, you're only given 1.5 marks for each of these points. So just be careful with your timing. So I'm just going to give the examiner a few examples so that I know that creative accounting can take place. Like, for example, recognizing the following year's sales this year, reversing provisions to create operating income not accruing for year-end expenses, and the like. Okay, so maybe just 2 of them would be sufficient. Go on to the next point. It says here that management does not consider it necessary to perform impairment reviews, and I make a comment here, that the audit team really needs to be skeptical. Okay, online revenue has grown this year by 20%. Overall revenue has fallen by 3.2%. This means that hard copy sales have actually fallen by more than 3.2%. So the fall in the hard copy sales have actually been masked by the growing online revenue. Therefore, now to ensure that impairment reviews are done for all 3 operating segments. So would you be able to reproduce this in the exam? It's actually quite easy. I'll show you how. So we're going to start off with the observation again. Stuff that is from the question. Then I go on to making the requirement here. So the team here is then required to be skeptical. The story here is management does not consider it necessary to perform impairment reviews. Audit team must be skeptical. And I'm going to give myself half mark there for the identify. Then I'm going to explain why do we need to be skeptical. And that is going to give me another half mark and what we need to do. So let me explain here. So this part here is about why. Audit team needs to be skeptical. Why? Because it doesn't make sense. Revenue for some of the segments are actually falling more than what has actually been disclosed. And therefore, now, what do we need to do? I mean, the thing here is this. This skepticism here is actually an attitude. It is in the auditor's mind, right? But being in the mind alone is not enough. It has to result in a certain action. We have to do something. If we're skeptical, we have to do something like here to ensure that impairment reviews are actually done for all the 3 operating segments. We've identified from the exam question that all the 10 million spent on developing the internal software, developing internally that software, has all been capitalized. And we're telling the audit team, be skeptical about this. So what do we have here? The observation, the requirement for the audit team to be skeptical. And that would be the half mark. Then why do you need to be skeptical? Because management may try as much as possible to actually justify why they should capitalize it, but it doesn't make sense. Because it cannot be that from the day that you start the project to the end, you're going from 0 to development. It's impossible. You have to go through research. So then now you're telling the team, this must be carefully checked. If they give you that kind of a story, then you have got to double check that. Next point is on the group accounting policy to amortize the publication rights over the average of 25 years. We're making the requirement for the team here to be skeptical. Why do they need to be skeptical? Because the rights actually relate to a period of 5 to 30 years, and therefore it's ridiculous that they're doing it over 25 years. So now what do they have to do? Now they have to look at the amortization for each of the 200 publication rights to make sure that they actually amortize over the legal period itself and not some arbitrary period of 25 years. Okay, on the next one, you've got the group accounting policy to spread the royalty advance over 10 years. That's the observation. The requirement for the team to be skeptical. Then why do they need to be skeptical? Because the finance director has got no better reason other than to say that it is just the industry practice and nothing to back it up. And therefore now they should ensure that the royalty advance is actually charged the P&L to match the period over which BASSET actually plans to publish these books. Final point here about the old software being transferred. Can you imagine old software being revalued? So the requirement here is for the team to be skeptical. Why? Because it doesn't make sense. It is an old software. How can you revalue it? Not only that, but they revalued it to fair value and it is unlikely to have an active market. So it's ridiculous. The value of this old software is probably nil. Anyway, Borzoi is not paying for it. Therefore, this transaction, what we need to do now is the transaction needs to be reversed. Are we good? So now we've finished with the part A of the question. We're going on to part B of the question. Again, I've already done the answer for you here just to save us a little bit of time. The definition of significant components, there are two types. One is a financially significant component where the revenue, profit, and the total assets of that particular component represents more than 15% of the group revenue, profit, or total assets. And the other one is a non-financially significant. This one is where the component's revenue or profit represents less than 15%. However, due to its specific nature or circumstances, here, exam question also goes on to say or ask whether Borzoi is a significant component or not. So we're saying that it is a significant component because, first of all, its total assets represent more than 15% of the group assets. So that's above the threshold. And not only that, but they've got other characteristics there as well. It is the only foreign subsidiary in the group. It's located in a country that is experiencing significant volatility in its foreign exchange rates, which means that when you consolidate this particular subsidiary, the figures coming from the subsidiary's financial statements are going to fluctuate significantly, and that's going to throw off the whole of the console as well. And another point here, it is unique in the sense that it is solely responsible for translating the publications from the other subsidiaries into foreign languages. So it's very unique to the group, and therefore it is a significant component. Now the next part of the question asks you about the extent and nature of the involvement of the group auditor in the risk assessment of Saluki, which is the component auditor. So here, let's have a look at this. Looking at the extent. So firstly, the extent of the involvement will depend on the significance of the component. And we're saying here that Borzoi is significant and therefore Whippet will be more involved, definitely, in the risk assessment. The second point here is whether Whippet is going to be more involved in the risk assessment of the component auditor, and that would depend very much on the reliability of the component auditor. Now, I've got some 5 points here that I'm going to put down in the form of an acronym. You know, I love acronyms, right? EQEAM. It just makes it so much easier to remember the points and to plonk them down in your answer. Now, the following areas would affect the reliability of Saluki. Number one, whether Saluki has the experience of being involved in group audits and is professionally competent in IFRS. And we're going to say that this one is yes, because we're also going to put down here that IFRSs are also adopted in Farland. So that's good. That's a plus point for Saluki. Number two, whether Saluki is professionally qualified and is licensed, whether they comply with the ISPA ethical code, whether Farland has adopted the ISAs. Now, I know they've adopted the IFRSs. The question actually tells you that, but I'm not so sure about the auditing standards. And whether Saluki operates in a jurisdiction that regularly monitors the quality of the firm. So these are 5 points that you can very, very quickly put down, that you would have memorized them as part of ISA 600 anyway. EQEAM is in ISA 600. So the less Saluki is considered competent, then there will be greater involvement as well. All right, so this is on the area of the extent of the involvement. Now, the question also talks about the nature of the involvement on the area of the risk assessment. So we're going on to the final part of our answer here to say that as a minimum, now these 3 points here are actually found inside ISO 600 as well. So in order to answer part B of the question, you need to be familiar with the requirements of ISO 600. So first of all, the discussion with Saluki on Borsoi's business activities which are significant to the group, including the financial performance, business risk, and preliminary assessment of internal control. Now, how do you know whether that part of the answer is correct or not? Now, let's go back to ISO 315. So when you look at ISO 315, it says that you have to understand the client, the entity, and its environment, right, in order to make the risk assessment. So how on earth are you going to understand? What are the areas that you'll have to go and study in order to be able to understand? There are 5 areas mentioned in ISO 315. You don't have to put down the auditing standard down, but I'm just trying to show you where these points actually come from. Which points am I talking about here? You know, here we're talking about this. Yeah? So where does it come from? It actually comes from here. So we've got this acronym here. Again, I love acronyms. IE-FBI, not CIA, okay? IE-FBI. The small I is industry. And in this particular case, we're not so worried about the industry because they're all involved in publications. Then the entity is the company itself, which we already have some understanding, but here I'm going to put down the financial performance, the business risk, and the internal control. So financial performance is the F, business risk is the B, and internal controls is the I. So that's where I've got those words from, just to let you know that we are making use of information that is from ISO 315. Then discussion with Saluki on items that might have a higher risk of material misstatement, whatever that they've found, maybe the inventory or whatever, okay? And then finally, reviewing Saluki's documentation of the areas of significant risks. I'm going to explain to you the area of significant risk, but you don't have to put it down in the exam, okay? So when you're talking about significant risk here, we're actually talking about the areas of fund cover. Remember we started off this question, we talked about DADS, D-A-D-S, and the S is the area of significant risk. So they would have to actually show you the documentation on how they decided that. Why is this so important? Why is it so important for us to look at documentation? Because the standard actually says that the area of significant risk requires special audit consideration. If it requires special audit consideration, then we need to know what it is to make sure that the component auditor actually audits it carefully. All right, so with that, we've finished BASSET.